I want to hone in on the interest rates. The interest rates in particular, we have a situation where a new customer, mortgage interest rates for new customers are said between 2.25% and 3%, but the existing customers are in the region of 4.5%. Now, we see all of the time that our mortgage interest rates here, particularly for existing customers, are higher than anywhere else in Europe. And they're certainly higher than what's needed to maintain the profitability of the banks. So my question, I suppose, is what do you intend to do about that? What can you do without that, or about that? And what scope do you have as a central bank to try and address that problem? Because I'd see that as being one of the biggest problems that we have at the moment when we look in terms of the affordability of mortgages, and then we look at some of the stats in relation to mortgage holders over 60 who still owe 150,000, more than 150,000. Then we have 15,000 mortgage holders aged over 50 that are on interest-only mortgage rates at the moment. So you can see where the problem is there in terms of consumers and in terms of your consumer protection role. Just what scope do you have and what intentions do you have to address some of that?
Sure. I'll thank you, Senator. I'll ask Ed, who's been looking at this issue in particular, to comment in a minute. But I just want to make a couple of points. Firstly, I have heard a number of people point out that mortgage rates are higher in Ireland than they are in Europe. And all I just want to signal is a bit of caution that sometimes we're not comparing exactly like with like, because the terms in which mortgages are provided in Europe can actually vary. So, for example, in some countries, borrowers need to pay upfront fees, which actually may not exist here. So just a caution around that. But on the other hand, the reality is that.
So would you? Can I just maybe just to clarify that, because that forms the basis, I suppose, of everything that we're discussing. So would you say then it's wrong to say that mortgage interest rates in the Irish market are twice the average level within the Eurozone?
Well, I was just going to come on to address that question. Mortgage rates in Ireland are higher than in some countries in the Eurozone. That reflects a number of things. It reflects the legacy of the crisis. It reflects the risk appetite of the banks. It reflects the different types of collateral and security arrangements that exist here compared to the ones that exist in Europe. But the issues of differential pricing in mortgages that you mentioned are, in our view, different to the ones in which we were talking about earlier in the insurance industry. But I'll ask Ed to comment on this.
So it's important, I think, to distinguish between the 2 points that you make. So overall, there's a number of points you made, but overall, there's the cost of mortgage interest rates in Ireland relative to the Eurozone average. And as the Governor has touched on, lending in Ireland, both from a kind of, well, lending in Ireland has been demonstrably riskier than lending in, kind of, from an average perspective. We have to be wary of averages in other parts of the Eurozone. Banks here have to hold more capital for the loans mortgage loans that they're making than in most other jurisdictions. So that necessarily does feed through into pricing. So I think it's entirely understandable, and that mortgages are a little more expensive here than the Eurozone.
But do you mean, sorry, can I just ask you, is it riskier now, as it is now in the current climate, than it would be in, say, Germany or Italy or other countries?
I mean, that's clearly there's work that we have done in terms of the macroprudential mortgage measures to improve the quality and the safety of mortgage lending today. I would note that about 4 out of 5 mortgages that are in the system today were lent before the mortgage measures came into force. So the vast majority of mortgage books today are pre those measures. And there are other issues within the Irish system that are not the same as other parts of the Eurozone, the use of insurance, for example, how affecting security works in other jurisdictions and so on. So it's not just purely on loan-to-value and loan-to-income, but clearly there are improvements in the safety of mortgages.
But wouldn't you think that would be reflected then in the interest rates?
So, so what we
that the work that you have done, I'm just trying to make sense of this in terms of being able to make proper comparisons. So in the work that you have done since the crash and all of that, in the stability and all of that with the banks, wouldn't you think that would be reflected now in terms of the growing profitability of these banks, that would be reflected in the interest that they charge their customers?
So the mortgage interest rates are on new loans are ticking down somewhat. They are coming down, right. But there is still a sizable difference between what's happening in terms of new lending rates and the Eurozone average for the reasons that I've outlined. Some of the underlying issues are changing a little. So the amount of capital that banks have to hold relative to loans, that's nudging down a little, but it's relatively small at this stage. We would expect that to continue to play out. But one of the things we've been really focused on for a number of years is really the functioning of the market. So how does the mortgage market function, both in terms of contract clarity, so disclosures, do people understand what they're getting into? Thinking about some of the kind of real problems that we've had in the market, including in terms of mortgage arrears and some of those issues around switching and disclosure around that. And what we can see is there has been some improvement in how the market's functioning, but there are still pretty significant issues in how it functions. But overall, to the kind of your first point, I think it is not inappropriate that mortgage rates in Ireland are higher than the Eurozone average because of the underlying risk. There is also
so do you think you're
something of a.
Then?
It's not for me to justify as such, but I'm just trying to explain it. There is also a factor of competition. So there are many other Eurozone countries that would have a more competitive banking market, so more players in the market than is the case in Ireland. But what we can see, as some of those fundamentals have improved, that the mortgage market is becoming more competitive in Ireland than it was, say, 2, 3, 4 years ago. And there are positives around that, in that we can see that mortgage rates for new loans are coming down. There's definitely more competition there than there was 2, 3, 4 years ago. I'm sure you'd remember that yourself. But there is also risks around that, and this is your second point, which is around, well, we're seeing differentiation for different products between what new borrowers are on in terms of new shortish term fixed rate mortgages relative to existing customers typically on variable rate products. And that was one of the things I was pointing out in terms of the culture in banks, to be making sure that they're not just doing what's legal, but they're also being consistent and trustworthy in terms of how they're treating their customers over the long term. And I'm not sure that's necessarily consistent with what they have been saying. So there is further work to be done in that area. We've been pushing hard in terms of improving and addressing some of the, making sure people are as aware as possible in terms of the benefits that are there for them in terms of switching from an old variable rate to a new product. But clearly a borrower has to decide whether they want to move from variable to a fixed product in the case that matters. But there are significant savings for thousands of people there through switching.
Yeah, but I suppose to get back to my question, so if you say you're dealing with some of the underlying issues that are causing Irish mortgage holders to have to pay higher rents than anywhere else, and at the same time we have huge profits being made and ever-increasing profits being made by the banks, it's very difficult for mortgage holders then to understand why they're not feeling some of the benefit, in terms of the banks that they would have bailed out. So is there scope for you to do more in terms of addressing the interest rates for existing mortgage holders?
So we are very focused on addressing those underlying issues within the mortgage market, which would make the mortgage market somewhat more attractive for new entrants, possibly. We'll continue to reduce the risks within the mortgage market itself. I'm wary about talking too much about bank profitability. Net interest margin is very high, not very high. It's higher in Ireland typically than the Eurozone average is, but we still have significantly higher cost-to-income ratios in Ireland than many jurisdictions. And overall levels of profitability in cold hard cash terms are significant, but from an investor profile perspective are less attractive. And that, I think, does come back to the Senator's earlier question about resilience. But we are very focused on addressing the fundamentals, and we are seeing that the market functioning is improving, but there are clearly still work to be done, including on the culture point that I made. You touched on a couple of other issues around older borrowers and interest-only borrowers. That they are obviously subject to the same protections. We have clearly articulated our expectations in terms of how lenders engage with borrowers on interest-only. We have very clear expectations. We'll continue to push in terms of sustainable solutions for those that are in arrears, and that clearly see there are problems there, and we will continue to push on those. But Derval might want to add on that.
I just want to add in two parts, which is right across all our different work, we seek to improve the context for consumers in the mortgage market, and part of the work that we did based on consultations that we undertook last year and in fact the year before was to bring really helpful information directly to the notice of customers so that they have a very directional prompt to act. So because we see that there are varying prices charged in the mortgage market, which is similar to many markets, not just in financial services, that's a feature of competition, we can see that there's a lot of customers who could make savings for themselves if they were prompted to act. So we strengthened the regulatory framework by making sure that people get more time when they're coming to the end of a fixed rate product, and they get information about cheaper products from their own lenders that are available to them. That's a new strengthening of the framework that we will hope will prompt people to move from that product to a cheaper product for them. And at least once a year, or any time there's a change in a variable rate interest, information is brought directly to the customer about a cheaper priced product that's available for them. Now that came into force at the beginning of 2019, so we hope to see dividend in that, because even without moving to switch between lenders, there's savings that people can make between products in their own lenders, and we see that that's actually having an impact on the behaviour of the lenders too, because they have to communicate this pricing to their customers directly. So we'll be keeping a watch on that to see if people, because there's value on the table for people themselves with these steps, and we want to see them take those steps so that they can get cheaper prices for them. And also another part of that is where people can get a cheaper product because the loan-to-value ratio is changing. We're demanding that lenders bring that information specifically to them. So all of those very directional prompts in the system have been put in precisely to help people make the changes that they can. And we've also strengthened switching, which is something we really want people to know is very possible to do. There's significant savings that can be done, and we would so we have done a lot in terms of strengthening the regulatory framework, and we would like the switching process to be more utilised, and Ed may be able to say something about the percentage savings that can be made, but these are things that already have been done this year.
Can I just ask on the switching, because I think that's very important, and I'm glad to see that you're taking that role serious, if you like. Are you measuring in terms of behaviour of switching? How are you measuring it in terms of the effectiveness of what you're putting in place?
So we actually have some behavioural economic studies underway across different parts of our work, and one of them is to examine the effect of information on customers with respect to switching, and we expect that's a real study with the presentation of information. We expect the results, that's a detailed piece of work, during the course of next year. We're also looking at, from inception, the customer journey in terms of the mortgage experience. And that's us doing a piece of real consumer work to find out what are the factors going on in people's minds and the impacts on them, their perceived barriers to it, because it's very important that the effectiveness of the rules and the framework that we put in place is actually tested through these in situ methods, so we can get real feedback on how to help people best to take up the action points that we want them to take up to see are they working. So we have two very separate pieces of work underway for next year. We're also doing something I discussed at another hearing in the the insurance pricing area as well, to see what is happening with customers. That will feed into the way we frame our work, and it will inform any policy interventions that we think will be effective and how we might intervene.
Yeah, I welcome that.
That's on work we are doing now in terms of what we are seeing today. So the level of switching in the market has increased significantly. So not quite to the levels, or not to the levels pre-crisis, but it's gone up from about 2% of mortgage drawdowns in 5 or 6 years ago to about 12% through 2018. I don't have the 2019 figures to hand.
How does that compare with the switching behaviour in the Eurozone?
I don't know that. We can look and see if we can find some information on that. But I think there's two different lenses to look at this. So the number of the percentage of mortgage drawdown, so how many people are drawing down mortgages and how many of those are switchers, which is increasing, has increased significantly. At the peak, it was in and around 19% kind of pre-crisis. But there's another way of looking at it, which is, well, how many people could actually save by switching either product or provider? And it's a relatively small fraction of that number. So there are clearly for lots of opportunities for people to switch and save. Tens of thousands of people could save money by moving product or provider. I appreciate it's not totally easy to do, but it is perfectly possible to do. And the other thing I would say, because we've had kind of plenty of discussion on this topic in the past, and we had a lot of discussion with Deputy McGrath around his bill around mortgage rates. We recognise that there are challenges here. We are trying and driving an addressing of the underlying fundamentals to make sure that the market functions better over the long term. We can see some improvements, but there clearly is more to be done, both in terms of kind of continue to strive to improve switching, but also in terms of, as we talked about, the culture and behaviour in some institutions.
I think the situation at 4.5% for customers is just too high. So I think, and I would ask you, maybe, Governor, in your new role, to continue to look at that, to see how that can be addressed in terms of giving a break to customers and to mortgage holders here. I wonder, I have several questions, but I want to kind of finish this as a lead-on question. In terms of the ones now that are interest-only rates, that are an interest-only, and that the ones that are classed as non-performing loans, what I'm concerned about is obviously the number of mortgages that are classed as non-performing loans being sold on, and then they're sold on again. Do you measure, apart from the criteria of the non-performing loans, do you measure the journey of how many times the loans are bundled and sold on from one vulture fund to another?
So our focus is very much on what is actually happening for the borrower in terms of engagement with the lender, whoever the lender may be, that they are dealing with them, with the borrower through the retail credit firm or the credit servicing firm in a way that's consistent with our expectations around the code of conduct of mortgage arrears, that there are solutions that are available to those borrowers that potentially would bring them on a sustainable path to curing the underlying problem, and that's really very much our focus. Yeah, and
I'm stuck for time, but in terms of them, so what customers are telling me is that one day they're getting, the loan leaves from the bank and they're dealing with one vulture fund, and the next day it's somebody else, and then it's somebody else on from that. Are we monitoring how these loans are, I suppose going back to the original crash, how the loans are being bundled and being sold on? I think that's an important question.
So we can come back to you with a fuller answer on that, but what we are monitoring is the agreements for the customers that have been made and ensuring that they follow. I accept that. And where there are changes in the market with regard to participants, and there have been some, there may be that different service providers take over servicing different books, and we do have sight on who is in the market and their role at a certain level, but significantly what we're looking at is the treatment with respect to the outcomes for the customer. But we can come back to you with a written response about the way that we do that.
Yeah, no, because I think they're really missing the point there, sorry, Chair, in terms of the loans being bundled and being sold on and then sold on again, and us measuring what they get enormous discounts from the banks in the first place. Consumers in the middle of all this, then it's sold to one venture fund and they make so much, then it's sold on again and they make so much. So there's lots and lots of money being made on the back of the original mortgage holder. And I'm also concerned on a macroeconomic level the impact that's going to have in terms of the loans being sold on it.
I think on your specific point, I think we'll write you a letter.
Okay.
And because you've brought together a number of different things, and I think it's probably worth our while just setting these out in writing.